Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. Despite the S&P 500 recently reaching record highs, tech-driven US markets have moved lower over the past few days. How are investment company managers investing in the US viewing the market and the recent sell-off? And what is their outlook for technology? How are they positioning their portfolios ahead of the upcoming presidential election? To discuss this, I'm delighted to be joined by Paul Niven, Manager of F&C Investment Trust, Fran Radano, Manager of the North American Income Trust, and Zehrid Osmani, Manager of Currie Global Portfolio Trust. Right. On to the questions. Now, why the US? Fran, obviously you're managing an investment company in the North American sector, and you're joining us from Philadelphia. Where are you currently seeing opportunities in the US? And if you could give us some examples of companies in the sectors, even better.
Yep. Yeah, I think in the North American Income Trust, we have both a growth and a dividend mandate, and we're finding opportunities, largely across all sectors, in a high quality, best ideas type way. And I think, you can start with the healthcare side. We know that an aging demographic is going to have different needs than what we've seen in the past. And what we do is look for companies that have both growth and value characteristics. And a company like Bristol Myers, sort of checks that box for us. It's trading at 8 times earnings. It pays a healthy 3% dividend. It has a nice pipeline from a recently acquired company and very, predictable cash flows. So I think, in healthcare, we see something like that. Conversely, on the defense side, we see a core holding like Lockheed Martin, that has a best-in-class, aeronautical division with the F-35 fighter that's in great demand, steady cash flows, predictable earning stream, long duration assets. And, we like a name like that over the industrial side. And then switching to the consumer side, we have a company like Home Depot, that has, home improvement story, and it's a high quality name trading at a reasonable valuation that we see, unabated demand for their services sort of in a post-COVID environment. And we got into this name, right at the onset of COVID when all the stocks were derated. And we see a company like that with great demand, great visibility, and sort of a long duration timeline as far as where we see that demand coming from. Finally, just one more, a company like Citigroup, I think, we look at the banks, and the banks were part of the problem 10 years ago. And I think this time we're part of the solution. And you see investors like Warren Buffett voting with their feet on this front. You see the bond spreads of these financials doing well. And a company like Citigroup trading at 0.75 book, we find, terrific value in that name.
Really diverse bunch of sectors and companies there, Fran. Zehrid, you manage a global investment company. I'm wondering how much you have allocated to the US and why, and where are you currently seeing opportunities in US markets?
Yes, we've got about 40% of the portfolio in US equities. That makes us about 18% underweight. So that's an important point to highlight. Where we stand out from other quality growth investors typically is we don't have any exposure to the FANGs. We find opportunities in some of the tech space, but away from those names. So we've got names like TSMC, CyberArk in the cybersecurity space, which we see as an area of accelerated growth as the economy has been shifting to online and to cloud computing. We also see a lot of great opportunities in the medical tech space. So our healthcare exposure is quite significant, but it's all coming from medical technology rather than pharmaceuticals. And in there are some great opportunities like Massimo, which is operating in the oximetry space. It's a 2-player market, so very much a duopoly, highly consolidated, which means low risk of competitive pressure, good pricing power, and that feeds into attractive growth, but also good steady returns potential for these companies. Or Viva Systems, which is a cloud software company for the healthcare sector, which again is an attractive growth area in a niche segment. So there's a lot of opportunities for us, a lot of ways of harnessing the US economy actually, because underlying we are about 2% overweight the US economy by revenue and by profits. But we find those opportunities outside the US equity market.
Interesting. Now, Paul, you also manage a very well-known global company around since 1868. How much do you have allocated to the US and why? And what does that US asset allocation add to F&C's portfolio?
So we made a decision back in 2013 to adopt a much more global approach to investment, and that meant cutting domestic UK exposure from around a third of the portfolio at that time to around about 5% today. We allocated that capital globally, but naturally much of it was allocated to the US. And as it stands now, we have around about 60% of our portfolio, just under 60% of our portfolio in the US. And this covers exposure to listed equities, large cap, small cap, as well as unlisted private equity opportunities. Now, we do have a diversified approach, and we do invest into what might be regarded as growth stocks, like Amazon, Alphabet, and Microsoft, but we do also have exposure to specific value strategy as well, which provides other benefits as well as income. In terms of what that US asset exposure has done for our portfolio, the US in general terms has delivered far superior revenue, margins, earnings growth, and basically added returns for shareholders. It's been the preeminent market globally for the past decade. It contains some of the fastest growing, highest quality businesses globally. And as I said, it helps us to meet our dual objective of delivering capital and income growth for underlying shareholders. And just to put a number just in terms of the extent of US outperformance against the domestic UK market, over the last 5 years, the US is up by around 125% in absolute terms against the UK, which is up by less than 20% in total return terms over that period.
Yeah, that number is a very convincing story for the US, isn't it? Right, Zehrid, I want to know what are the key risks you see in the US stock market at the moment and how you're trying to mitigate against them?
It's a good question. So on the economic side, clearly the uncertainty on the economic recovery is one area of risk. US elections is the other one, given that that will then dictate economic policies and whether the recovery does follow through and to what extent. Both candidates offer some sizable infrastructure spend as a way of stimulating the economy. Biden has got a more front-loaded plan, and therefore there could be more momentum there, but there's also some less business-friendly initiatives, notably on the tax front and also on the minimum wage front. So those are the risks on the macro side and the policy side. In terms of the corporate tax, clearly that could be a negative impact for all corporates. And that's something we've incorporated in our forecasts. Actually, we've decided that given the magnitude of the fiscal spend that is being pledged, that will likely lead to increased tax rates. And therefore, we've anticipated them through putting them into our models. The low rates environment is another potential challenge for investors generally. And the search for yield as a result will be an important aspect to consider for investors. So something that the Fed has very clearly messaged that those low rates are going to be there for extended periods of time. Therefore, there will be implications in terms of the search for yield, the attraction of the equity market itself in terms of earnings yield relative to the bond yields will be an important aspect. So there are risks, but there's also some support being provided as we're also getting out of lockdown and as we're facing an economic recovery. So from our point of view, there's still quite a bit of uncertainty there. Shape of recovery is something that a lot of commentators are talking about. From our point of view, we don't see a return to full economic activity until at least 2022.
Right, yes. So Paul, thinking about what Zehrid just said, what are the key risks you see in the US stock market at the moment and how are you trying to mitigate against them?
Well, look, I think as always, there are always numerous risks, but I think at the present time, the biggest risk the markets face, in my view, relates to the economy in corporate earnings. We've seen a recovery which I think has defied the bearish expectations so far, but we've clearly got a long way still to go to recover lost output. We've had consistent beats to economic expectations, earnings expectations in recent months from a very low base. And it looks like we should be heading back to earnings growth in 2021, which is obviously a positive. Whether that happens or not will partly, I think, be driven by government policy, which in turn comes back to the virus, one of the biggest risks facing markets right now. The economic downturn was really caused by choices made by governments which were intended to protect health of citizens. So I think the positive aspect of that is that we didn't come into the recession with very large financial imbalances, which maybe means that the hangover will be shorter this time than post-global financial crisis. But clearly, if governments do decide to impose more lockdowns, that'd be terrible news for the economy and for corporate earnings, and indeed for stock markets more broadly. And if earnings don't come through, then valuations in US equities, which look relatively high, will not be supported, and markets are going to be at risk. And part of that risk in the US market, frankly, has been the dominance in terms of a small number of stocks within the market that have had very superior earnings growth, but are now obviously pushing on to high levels of valuation. So I do think we need to acknowledge this point on US valuations. It is a concern. You can have great companies, but the price you pay for a stock does matter at some point, and the leaders are pushing on to expensive valuations. That said, my personal view is that the environment is still fundamentally constructive for secular growth, winners taking an ever larger share across and within sectors, and the policy, importantly, is supportive for valuations as well. So I don't have a strong view we've reached a critical point where markets are going to collapse under their own weight from valuations, but that is a risk that we will ultimately reach that point of outright excess. Very briefly, just in terms of mitigating risks, first, I do think it does help to have a long-term perspective, because there are always short-term risks and there's always short-term noise. Practically, though, diversification, in our view, makes sense. Don't bet ranch on one particular outcome. Obviously, express views on the portfolio, but excessive concentration for the end investor, I think, is a double-edged sword. We do run a range of concentrated strategies as part of FCIT in order that we add returns while reducing risk for investors.
Yeah, I think that diversification argument is very reassuring for investors who are listening at the moment. But I have to say, Paul, I think there's quite a lot of optimism coming from you there. And it's good to see some surprises on the upside. We always think of the US as the land of opportunity, the land of enterprise, and some of that seems to be coming through. Fran, what are the key risks you see in the US stock market, and how are you trying to mitigate against them?
And I think we've spoken to some of them, but I think, what we're looking at now is a lot of the stimulus packages, specifically the fiscal stimulus, has really propped up the consumer in terms of an unemployment safety net, as far as other means to help that consumer. And there's also a lot of stimulus targeted at small business, which has helped them survive, through this period. As these programs begin to lapse, we need a second round of stimulus. And I think that the important, trade-off here is it's done properly and prudently, but yet it has to be done and it can't be caught up in politics, which right now it arguably is. So I think in the near term, that's a risk that we look at. I think when we look at more of the intermediate term, which is really important to us, it's, does this event weaken balance sheets? Does this enter a period of underinvestment? And we really need to be on top of our corporates to make sure that they have the wherewithal and the financial wherewithal to get through this, and they're not cutting corners, they're not burning furniture to pay for the bills here, but they're properly investing, they're strengthening the balance sheet. And I think that those are sort of the key risks we look at, and simply put, diversification still matters, and buying, good companies at fair prices at the end of the day is a winning formula, we think.
Great. Well, I am moving it onto politics now. How could the result of the upcoming election have an impact on the market and your portfolio? And I'd like to ask that question to Fran.
Yeah, I think, that there's probably two logical or most likely outcomes. One will be a Biden presidency with a full Democratic sweep. There's a Biden, presidency with a Republican Senate, which will, a bit of a firewall as far as policy implementation. And obviously there's the status quo. And I think when we construct portfolios, we're really looking to build all-weather portfolios. We're cognizant of presidential politics, obviously the platforms that can be implemented. Higher tax rates are material, could be a material hit to earnings. It could be single digits, low double digits. So we need to be cognizant of that. But if we build an all-weather portfolio, we feel confident that we're going to be able to get past this. I think with the Democratic platform in sort of the extreme Democratic sweep scenario, we need to be, aware of higher taxation at the corporate level and the personal level. We need to be aware of what a Green New Deal looks like and the cost to corporates on that front, as well as just increased regulation, whether it's financials regulation on the banks and investment banks, or whether it's, no fracking on government lands and what that could do to energy companies and oil prices more broadly. I think in the middle ground scenario of a Biden win and a Republican Senate, I think, a lot of these things are muted. A lot of the, the tax increases, the regulation may be muted. And, arguably Biden should have a more benign, global trade policy. It won't be a bully pulpit. It won't be governed by tweet. And I think also, so that's important. I think also the immigration, reform, I think will be a lot more benign. And I think both of those things are very important for the long-term health of the economy.
Absolutely. Paul, how did the impact of the upcoming election, do you think, affect the US market and your portfolio?
So I would argue that markets, perhaps for obvious reasons, have not been as focused on this election in the run-up, up to this point at least, as they have previously. Up until a couple of weeks ago, the odds were clearly suggesting we'd have a Democratic clean sweep in November, President, Senate, House. Last couple of weeks, things look to be much more finely balanced. Trump and the Republicans appear to have regained some momentum. So it does look like it's going to be a close run thing come November. But I would say that the risk of a Republican win is probably underestimated at this point. To some extent, I think the news flow in terms of COVID, the virus, will be a significant driver in terms of what the actual outcome is. The more news on the virus improves, probably the better it is for Trump's odds of re-election. In broad terms, as we've discussed, the Democrats' policy, probably a bit more easy by way of fiscal policy. Both sides will be looking at infrastructure spending clearly, but tax hikes are clearly a concern and a risk. The headline from Joe Biden is 21 to 28% rise in corporate taxes, rising minimum wages. So probably a slightly less market-friendly response than what might be the status quo if Trump is re-elected. So in simple terms, Republicans may be more constructive for recent trends that have been in place, while the reverse is true for Democrats. But I do think this point about the impact being somewhat muted is absolutely right. We clearly have a very difficult backdrop, and some of those headline pledges may not turn out to be fully implemented. And no matter who wins, they're going to inherit a very, very sizable federal deficit, $3 to $4 trillion rise in federal deficit, recovering economy, which is still going to be relatively fragile, I think, and potentially no vaccine until at some point next year. So it's going to be a challenge regardless.
Yeah, the impact of COVID is really there, isn't it, on the US economy? But Zehrid, I'd like to ask you what you think the upcoming election, its impact on the market will be. Over to you, Zehrid.
Yeah, we're in this unusual situation where we're having to accept that Biden winning and a clean sweep would be what brings uncertainty to the market, more so than the current status quo. Although in terms of reading the policy intentions, generally it will be seen by the market as less business friendly. We've talked about corporate tax rates going up, minimum wage increasing. In terms of infrastructure spend, we did mention about the fact that Biden's plans tend to be more front-loaded and therefore could be more supportive for the economy. In terms of where that's being channeled, or where that would be channeled, green energy, efficient buildings, electric vehicle incentives, those type of focus on reducing the carbon footprint of the economy is an important area. The flip side of that, of course, is negative for carbon-intensive sectors like energy, dirty utilities, and basic materials, for example. On the healthcare side, Democrats are looking to extend Medicare to a bigger part of the population, so that on the edge would be positive for medical tech companies in particular. Drug pricing will always be a talking point, so large cap pharma will be in the firing line, even if actual policy action might be less impacted. And then on the big tech side, the anti-monopolies policy intentions and also focus on data privacy will be a potential important focus for the Democrats if they win, and therefore that could be an impact. On the geopolitics side, I guess that will be interesting in so much that the Biden administration would not necessarily be less aggressive on China, but will certainly potentially be more diplomatic in how they're dealing with China than the Trump administration. So that's something that we'll need to see how things play out there.
Yeah, there's some really very significant differences there. Moving on to your long-term outlook for the US. Paul, the US has rallied strongly from the sell-off. Is there further to go? Obviously, we've seen a recent sell-off in the last couple of days. Is that telling us valuations have got ahead of reality?
That clearly is a risk. And a lot of the drivers in terms of outperformance of growth and indeed the US, frankly, haven't changed in the last couple of days. But it may be the case that at some point, and as I said earlier, I don't think we're quite there yet, at some point we reach the level of valuations which really are prohibitive of future absolute and relative outperformance. The US has clearly been a leader or the leader in global markets for more than a decade, significantly outstripping returns elsewhere. Why? Because it's delivered superior fundamental earnings growth driven by higher margins, higher revenue growth than that we've seen elsewhere. So there's clear sense in terms of those excess returns that investors in the US market have enjoyed, in the sense they've been driven by fundamentals. But investors are paying a lot more for those successful companies, which a large part, an increasingly large part of the US, paying a lot more than they were before. I think part of this is due to the fact that recession has entrenched the position of winners, but it's also clearly about policy. Easy policy, negative real rates are supportive of equities and supporting long duration growth, which constitutes a large part of the US market. So I think the outperformance of growth against value is extreme. The outperformance of the US against other markets is also looking pretty stretched relative to history. And the value of value is quite extreme as well in terms of being cheap relative to history. But on balance, I think recent trends probably will continue to prevail for the time being, helped by policy and superior fundamentals for those businesses. Longer term, many US companies, I think we have to acknowledge, are winning not only because of superior innovation on their part, but also in many instances due to lack of effective competition across many sectors, high barriers to entry. So this point about regulation as well as valuation, those two aspects longer term, I think, are the key areas that may ultimately lead to the ending of US dominance.
Right, but you're saying that's quite a bit further longer term than now. Right, so Zehrid, moving on to your longer term outlook for the US. Obviously, it's had a very strong rally. We've had a bit of a sell-off in the last couple of days. Will it continue to thrive or not? Are there opportunities outside the tech sector, or is it still going to be the tech sector that leads the next stage?
Yeah, on the tech side, we think there are still opportunities, and they are quite varied. It doesn't have to be in the FANGs, which arguably could carry some risk of investor concentration, at least in the short term. Absolutely valid to think about it long term, and we think there are opportunities through various parts of the tech space, not just around the platforms. The whole ecosystem is interesting, and there are ways to play the ecosystem, like the Amazon ecosystem, but without being invested into that specific company. Outside technology, we're very exposed to healthcare, and within healthcare to medical technology. And that's where we see an attractive long-term structural growth driver. And again, there are some varied opportunities, whether it's in genomics, whether it's in home care opportunities, or patient monitoring, with remote patient monitoring being an important emphasis post the pandemic crisis. So again, some good opportunities there. The importance of thinking long-term means you can really look at capturing some long-term structural trends. The other area, which is somewhat related to technology, but where you can gain exposure through the industrials, is the trends towards increased robotics and automation. We think that will continue. It could potentially accelerate if we've got a trend towards onshoring or nearshoring, which is what some commentators are talking about post-pandemic. And that can be an attractive potential long-term trend. And then, of course, the whole aspect of infrastructure spend being channeled on greener initiatives, whether it's green energy, greener buildings, green forms of transportations, all of which is leading to some interesting opportunities across these three end markets effectively. And then finally, let's not forget, post-pandemic, there will be an increased focus on hygiene, and that trend will be there to stay, whether it's food hygiene or premises hygiene, both domestic and professional premises. And there again, there are a few companies that could be interesting, and we'll be seeing some strong tailwinds.
Thanks very much, Zehrid. Clearly, a lot of these trends and these sectors you're identifying have been helped in a way by the coronavirus impact, because things like infrastructure spending will increase, and healthcare obviously has been a beneficiary, and technology. And I think it's fascinating that you're finding opportunities outside the FANGs, really across the spectrum. Fran, what's your long-term outlook for the AOS here? Are you seeing technology driving it forward? Are you seeing opportunities in other sectors?
Yeah, no, I think technology is an important part of the market, obviously, and as mentioned prior, it's pervasive. It's not just in the technology sector; it's in the industrial sector with the Internet of Things. It's in the market exchanges. We own a company called CME Group, a derivative exchange operator that is almost all technology. So I think that's important. And even in something as basic like a railroad, you see next generation technologies helping them become more efficient. So I think those are all important parts of the market that are, longer term in nature, where technology is really becoming pervasive, and it's not just simply, a semiconductor company or a cloud computing company. And we've looked at other opportunities like within the infrastructure of such. So we own a data center provider called Digital Realty, and what they do is they provide the data centers, for the cloud computing. So they build the properties. We get a competitive dividend off of that, and they participate in the global growth of this. So, I think there are many ways you can look at it without buying companies trading at 100-time multiples. And we own a company like Texas Instruments that has the Internet of Things type, applications in industrial and in automotive, where you can get sort of broad exposure to increasing technology content in very generic, basic, whether it's an automobile or whether it's a tractor, or whether it's another industrial application. So I think that technology is pervasive, but I think it's clearly not limited to a certain subset of names trading at high multiples that are very crowded trades, broadly speaking. So I think that's our job as managers, is to focus on where we find the best, combination of growth, but, buying these at fair prices.
Great. Well, a lot of optimism there, and a lot of opportunities for you as US investors. I'd like to very much thank our managers for joining us today. It's great to hear their views on the US, but I'd like to emphasize we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thank you so much for watching.